Hi, thank you for your time today. My name's Stephen Wood. I'm one of the principals and a portfolio manager of Eiger Capital. Eiger Capital is part of the Fidante stable of investment managers, and we're a small cap specialist. Eiger Capital is just coming up 3 years old, but really, as you'll see later on in the presentation, has more than a 10-year track record because the three principals, myself, Victor Gomes and David Haddad, have been working together for a decade in the small cap space, and our business was set up as the three of us transitioned from another manager and brought our clients and our track record with us. We, between the three of us, have a combined 70 years experience in financial markets, and as I mentioned, we've been working together as an Australian small company specialist for more than a decade. We have a investment thesis and system that we'll go through in a moment that we've used for more than 10 years in the Australian market, and the track record has been proven through a range of economic cycles with both markets that are rising and markets that are falling. It's a cash flow based model, but we'll get to that in a moment. The other key feature we'd like to point out with Eiger Capital is that we only invest in our product, so we're totally and utterly aligned with our customers. And in addition, the three of us all have a significant stake in the business, so we would like to think that we're completely aligned with our customers in that regard. Why do we really like small caps? Well, there's a range of reasons. I mean, firstly and foremost, let's just remember that small companies can grow at much, much faster rates and for longer periods of time than the overall Australian economy. In addition, the great thing about the small cap space in Australia now, and this might come as a bit of a surprise, is that it's much more globally diversified than the big caps. We invest in a range of businesses that have both export operations, for example in the mining space. We invest in businesses that have substantial offshore operations, and we can point to companies like a Domino's, for example, who have significant operations now in places like Japan, Taiwan, and Europe. And we invest in tech companies whose businesses, like the elephants in the world, have spread globally and have fabulous platforms, and I can point to businesses like Life360. So while it's Australian small caps, it's worth bearing in mind that it's small businesses in Australia that are often globally present, and that provides the sort of growth that enables us to invest in businesses that can grow for long, long periods of time, and importantly, are not constrained by the Australian economy. What is our investment approach? Well, firstly, the thing about an investment approach, particularly when you're a bottom-up small cap investor like ourselves, is fundamentally you've just got to find the next good idea. As I mentioned earlier, we've been around for a combined 70 years across the three of us, so we have deep contacts out there in the Australian financial markets, and we use those to get ideas wherever we can find them. We are talking to the broad Australian financial community every day. We read a lot, we've obviously got our own views, and we synthesise all of that combined with an extensive program of company visits. We, for example, one-on-one interview and visit more than 200 companies a year, and if you combine that with following the AGMs and other company presentations, that number extends beyond 500 company interaction points per annum. So we take that top of the funnel, if you like, and we feed that into our investment process, which is a standardised model that, as I mentioned earlier, we've been using for more than a decade, and our track record comes from that. So we take those ideas, we funnel them in to a cash flow based model where we do our own homework, and I just also point out at this moment that we also do invest in resources, which we regard as a key Porter based financial advantage for Australia Inc., if you like. And many of our peers don't do that, but we regard it as a very, very fertile ground for generating returns for our investors. So we model up our own companies, we do our own homework, and then following on from that, we apply a range of qualitative filters that once again have come out of that long experience that we've got and our interactions working together and interviewing the companies. And we'll come to those qualitative factors in a moment. If I could start with what characteristics of a business that when we first decide, hey, let's have a good look at this, that we really like. And there really are three. as I mentioned earlier, it's just got to grow. We are investing for the medium and the long term, and we want to create wealth for our investors over that 5 to 10 year period. We want to give them real money that they can retire on and take to the shops and spend. And in our view, the best way to do that is just fundamentally to find companies that just get bigger. Because if companies can get bigger and they can make a good profit along the way, share prices go up, wealth improves. So what are the characteristics we look for? Number one, I've mentioned growth. Number two, as you can see on this diagram, clearly at some point over that modelling period that we focus on, which is about 5 or 6 years, a company has to generate a good operating cash margin. So hence, we want growth, and at some point during the investment cycle, we want some margin, and preferably a margin that expands as that company gets bigger. And finally, the other key factor we look at, which is something that is very often overlooked by financial markets in general, is the cost of delivering one, growth, and two, margin. And that cost is capital expenditure, the cost of acquiring businesses if you're going to grow that way, or the cost of investing in intangibles, and they can be things like, for example, software. So our model prices a combination of growth, margin, and the cost of achieving the first two. That then gives us a ranking score, which we call an alpha score. But we are not a formulaic asset manager. We rely on our experience and we rely on some lessons that we've hard learned over a long, long period of time. And we call these our 9 commandments. They're set out on this page. Some of them are a bit hokey and they're kind of a bit obvious. And they go to things like we invest in businesses that we understand. We try to avoid poor industries. And poor industries, by the way, often get flushed out in that modelling process because companies in poor industries just continually invest and don't grow. So it's very interactive in terms of what we're doing between our quality filters that you can see here in our 9 commandments and the modelling. We like to invest in industries that have structural change, industries that are the industries of the future, not the industries of the past. And there's a couple of commandments on this page that people often laugh at and go, well, what's all that about? I mean, take for example number 7. We're very, very focused on what our management teams are doing with their own stakes in these businesses. We don't like it when management sell large amounts of their stock, often in the run-up to results. We take a pretty dim view on that. We often sell out and never ever go back. And the last one obviously always gets a smile. Everybody thinks that the sort of game we're in, small cap investing, is probably all about IPOs and snuggling up to investment banks. The truth could not be further away. We do not generally participate in IPOs. We take a pretty dim view of investment bankers who become managing directors of our companies. By and large, if companies employ large amounts of consultants, we don't like it. We want to employ management who know what they're doing, not management who rely on a whole bunch of consultants to tell them how they should be reshaping their business for the future. Just as a couple of, summary slides. So really what we're looking for over a 5 or 6 year view is companies that grow, generate a margin, management we can rely on, management we can trust, management that give us the confidence to generate those 5 year numbers and have a reasonable outlook that might actually be achieved. And so these businesses just quite frankly compound up your wealth over a reasonable period of time. And that just, is highlighted by these 2 slides. They either just compound up or we get structural change in an industry and that over a 2 or 3 year period that plays out and a company's margins improve. And in this Venn diagram, you can see those 2 forces either separate or interactive. We're happy with one, we're happy with the other, or you've got some companies there like Tech1 or Life360 that have been a couple of our really successful investments over the last half decade that, sit right there in the middle. Just quickly on our fund, before we perhaps get to a couple of examples of, bringing all this together. It's benchmarked against the S&P ASX Small Ordinaries Index. We have a limit of a 5% active position in the fund so that no one position ever gets too big. And that probably is a key part of our risk management as we put the portfolio together. So typically 30 to 35 names, maximum bet in the portfolio is about 5%. And therefore, if we can generate alpha, we'll end up with a return that at a maximum is as risky as probably the ASX 200. So less risky than the Small Ords because we do diversify the portfolio with about 30 to 35 names, as I mentioned. There's the returns set out for our fund over the course of the last more than 10 years. As I mentioned at the start, Eiger Capital is only 3 years old. You can see that in the top half of that page. The bottom half sets out our track record going back to the point where myself, Victor and David came together at a former employer, and it is worth bearing in mind that our track record there is contiguous. There were no gaps between where we were before and the establishment of Eiger with Fidante. Perhaps now I'd just like to come to a couple of stock examples, companies that we've held, in the case of ARB, which we're going to talk about now, for a decade. ARB, as you may be well aware, makes bull bars and car accessories. They are just a fabulous business based in Melbourne. It's still run by its founders. It has been around for a long time. It's an Australian iconic brand. But when you get to know this company, you might be sitting there saying to yourself, well, heck, they make bull bars and racks for the back of a Toyota Hilux. Well, how can this be the sort of business that you want to invest in for the long term? And it fundamentally comes back to the fact that this is just an exceptionally well-managed company that make an exceptional product. And it might sound simple, but it's not that easy. And it is worth reflecting, and you can see from that picture there on the page, that they are now one of 3 global suppliers to Ford for their new Bronco that they've just released to much fanfare in the US, selling like hotcakes, and there it is, all accessoried up with ARB. And as I mentioned right at the start, often investing in small caps is not about that tradies Hilux driving around in your neighbourhood in Australia. Just reflect on the fact that that equipment is made in Thailand by an Australian small company, and it ends up on the hottest selling 4x4 in the US. And that's often what investigating these companies is all about. And also just flipping to perhaps a structural change, and that is the advent of EVs and the rollout of smart grids, which are coming to us thick and fast. And we've just had a big reminder with COP26, just how much energy now, pardon the pun, is going to into this sector worldwide. One of our favourite and best performing businesses over the last 2 or 3 years has been Pilbara Minerals. We are big believers and investors in what we'll call now advanced minerals. It's lithium, it's rare earths, it's cobalt. These elements are essential for batteries, battery technology, and advanced vehicles. Like, for example, the new electric F-150 that's about to go on sale in the US, the world's biggest selling vehicle, is going to be full of batteries. And somewhere, the lithium and the cobalt and the rare earths and the copper have got to come from somewhere. And, in the case of Pilbara, it has one of the world's largest, longest life lithium mines anywhere. And, it's been a spectacular performer for us in the last few years because lithium has now become a real thing. And this is a big mine right at the bottom end of the cost curve. And the mineral is now in high demand. So thank you very much for your time. If you want more information on Eiger Capital, please feel free to visit our website at eigercapital.com and/or fill out the information page that's coming up shortly after this presentation. Thank you so much for your time, and we look forward to hearing from you soon.